This is a debate that's gone on for years, and it's changing. So I thought I'd revisit it once again. One of the biggest questions people have is, what is the difference between angel capital and venture capital? And indeed, even private equity. And this is a debate that's gone on for years, and it's changing. So I thought I'd revisit it once again. And first of all, these things are all related. Think about this as concentric circles. We've got private equity, which is this largest sphere. And private equity is simply equity from private people, not on public markets, being invested into companies or buildings or whatever it might be. Below that is venture capital, which is still a type of private equity, but typically investing in earlier stage companies, usually making investments of 10 to 20, 30% in a round. And so it's investing in companies, growing them and exiting them. Angel capital is private equity. It's individuals who are either as a group or as an individual investing in early stage companies, hoping that they will grow and then sell them and profit from that. So very, very similar to venture capital. So people ask, well, what is the difference? And really, in technical terms, all three of these are a subset of private equity. So they're all the same, and yet in practical terms, we think about them differently. Private equity is typically larger companies. We're doing a bunch of different strategies. We're rolling up a number of companies in the industry to get some sort of a oligarchy or competitive advantage or regional advantage. And then venture capital is typically going to be later stage than angel investing. So we'll see the institutional rounds coming in at Series A, B, C, D, E, F, and those are typically going to be the venture capital rounds. Typically, when a company reaches product market fit, and now this is money to throw gas on the fire and grow it and exit it. Angel money is working the same thing. Angels, and this is important, want to make as much money as VCs. They want to get 10 to 30x on their investment. They're taking the greatest risk. Companies are unproven, often pre-revenue, not much to show for what they're doing, but of course the prices are less. So angels can benefit by having a 10x return before we even get to Series A. So the other big difference between angels and venture capital is angels are investing money on behalf of themselves, whereas venture capital, by definition, is taking the money of their limited partners, and then as general partners, they are making and managing the investments. So angels are free to make investments in whatever they want, beholden perhaps only to their spouses, but not to others with a fiduciary duty. Now, with all that being said, things are changing pretty drastically. So we have all kinds of intermixtures of these occurring. So we see private equity funds coming in and buying early stage companies and maybe even buying less than 50% of the equity in those companies. So that's looking a lot like venture capital. They're adding value and then selling. VCs are creating scout funds and coming down into the angel area. They're trying to get their claws into companies and get their pro rata for follow-on investments. And so they're coming down to the pre-seed and seed stage, often driving up prices because they're not price sensitive in the way that an angel investor would be. Of course, the net effect of that is it fouls the market because prices go up, but exits don't go up commensurately, and the time to exit becomes longer and longer. So the sort of intermingling can have negative effects as well as the positive effect of institutional money coming down to earlier stages. And now what you see is angels looking for other opportunities, and they're going upstream while the VCs are coming downstream. So it's all mixing together. So I see a lot of angels who are doing Series B, C, D. We've even done a Series G at Rocky's Venture Club. So it's certainly possible to be doing later stage things as angels. You may not be coming in with investments of $50 or $100 million, but maybe maintaining your pro rata and keeping things going in those later stages, or jumping in on an existing investment and starting at Series B or C. So lots of great opportunities for angel investors to do later stage. Maybe they won't get the 10x, but if you can get a 2 or 3x in 1 or 2 years, that can be a definite win. Additionally, we're seeing angel groups starting to think about buying companies. And they buy the companies, put in great processes, management, build up the marketing, and then flip it just like you do a fix and flip on a real estate project. So angel investors are looking at things like that, which is sort of a mini private equity. So with all that being said, AI is driving some of this. The other thing that's happening is AI is sucking 60 to 70% of all of the venture capital out of the market and into these large investments. And so that means that there's a paucity of funds available for the early stage companies. And this has really caused a problem, especially for those companies who's already raised capital and now they're having trouble raising that follow-on capital. They've reached milestones, they're showing progress, and yet it's all been sucked up into that big fire of artificial intelligence. So things to keep in mind, we're seeing rapid changes in the way the capital is distributed among types of companies and the ways that investors are looking at different types of things. So this is a great time for angel investors to get involved. But the rules are changing, and smart investors can succeed if they pay attention to these new rules, new roles, and look at opportunities. So thanks for visiting VC at Sea.